Hi everyone, it's Jack back with another video. Today I'm going to be talking about defence contractor and aerospace company Lockheed Martin, a company that's actually done fantastic compared to the S&P 500 in the past year, up 18.6%, still decently high from its 52-week highs of near $500 against an S&P 500 that's down 20% or so. It's way above its 52-week low of $370, but still not overly expensive. A P of around 20, 2.7% dividend yield. It's been buying back quite a few shares. Has recently announced its fourth quarter results, which I'm going to go through in a minute. And its market cap is sitting around $116 billion as the biggest defence prime right now. I think it's an interesting company. There's had a long history of returning cash to shareholders and outperforming the market over the last 20 years or so at a fantastic rate. I think it's worth a look. I'm going to dive into the fourth quarter results now. Despite the stock's performance, 2022 was a challenging year for Lockheed Martin. It did struggle with some supply chain constraints. Obviously, pretty much everything it's building is huge with a lot of parts, a lot of moving parts, and that being an incredibly intensive supply chain that can be easily disrupted by many of the disruptions that are going on in the economy right now. So in 2022, the revenue was actually down versus 2021, recording just shy of $66 billion in sales compared to $67 billion the year prior. Segment operating profit was down by about $100 million to $7.2 billion. It's still strong operating profit, 11% margins in 2021, 10.9% in 2022. It's not that much difference. It just came down as a product of the revenue coming down. Earnings per share on an adjusted basis was marginally higher, $27.23 compared to $26.75. However, on a GAAP basis, it's actually down by about $1 year over year. Weighted average diluted shares decreased by about 12.8 million because they've been buying back shares. I'll talk about in a minute. Overall results wise, obviously it hasn't been a fantastic year for this business, but given the supply chain constraints, I think this business has performed reasonably well. The performance was really backloaded, weak performance at the start of the year, and they kind of figured it out by the end of the year, with the most recent results coming in at the top end of expectations. They recorded $66 billion in sales, $7.2 billion in operating profit, of which was converted to $6.1 billion of free cash flow, $21.66 in earnings per share, giving it a PE ratio right now around 20. It recorded $7.9 billion of share repurchases and $3 billion in dividends. So a lot of this was part of the strategic capital deployment plan we spoke about earlier, as it's obviously greatly outweighs free cash flow. $7.9 billion, they've obviously think that the share price is relatively cheap right now, which I kind of agree with. They put in $3.4 billion into independent research, as they will consistently need to do. They maintained a book-to-bill ratio around 1.2, which is typically where it's been for a long time. Lockheed Martin announced a few quarters ago basically that revenue was going to be flat, maybe some slight declines over the next year or so, and that investors were just going to have to hold on, accept the share repurchases if they wanted to hold on to this business, and accept a small amount of increase in the share price, basically due to those share repurchases and the dividend and the intrinsic safety of this business, and that eventually they will return to revenue growth once the supply chain constraints have eased on this business. As I mentioned, incredibly tight supply chain, lots and lots of components for the many things they produce, and as a lot of the revenue is tied up in government contracts, there's a long-term reliability to this business, and they can kind of see revenue coming from a long distance away. And that is reflected in the outlook here. $65 to $66 billion in sales. If that's their outlook they've given in January, not particularly rosy outlook. That's going to be at the top end of that expectation. It's going to be flat revenue. Segment operating profit is again a slight decrease of around 3 or 4%. They're expecting diluted earnings per share to be around $26.60 to $26.90, which is just about flat, and free cash flow to be about $6.2 billion, which again is around flat. They're going to include $4 billion in share repurchases, so realistically we can expect share count to drop slightly less than it did, maybe by around 10 million. Still, this is not particularly inspiring for protected shareholders, so we need to have a look at how this company is valued and whether it is a screaming bargain right now, even with the couple of years of revenue flat growth, or if it's looking a little bit expensive. To do this, of course, we're going to do a discount and cash flow analysis of this business to work out an intrinsic valuation and a fair value to pay based off the sum of its future cash flows. This business, over the last 10 years, has averaged a compound annual growth rate of 16.3% for free cash flow. I don't think this is realistic to achieve going forward. I think somewhere in the 5 to 8% range, average over the 10 years, is a much more realistic target, particularly when considering there's going to be very little growth over the next 1 or 2 years. I think a 5% is a fairly conservative estimate. I prefer to be conservative when I'm doing my DCF calculations. Using this and a 4% terminal stage growth rate and an 8% discount rate to mimic the long-term returns of the stock market, this gave a fair valuation of $468, slightly above the stock price today of $449. This isn't a particularly expensive stock. It isn't cheap by any means. I think this is reflected in its price right now, and the sort of growth it's achieved recently shows its strong defensive capabilities. This to me is the very definition of a defensive stock, literally being a defence contractor. Much of its revenue is tied up in long-term government contracts. The world is not getting a safer place by any means. There's still a war going on in Ukraine, and the American government is pumping a lot of dollars, surely many of which are going to go to Lockheed Martin. It's continued to pay its dividend for 20 years, a 5-year growth rate of 8.85%. It will continue to make share repurchases, probably around 2 or 3% of the shares outstanding going forward. It only has a 41.67% payout ratio. It's 2.7% dividend yield as it sits now. This is clearly a defensive stock that people were very happy to invest in while there's a lot of geopolitical trouble going on in the early 2022. That's where its stock price mainly rose from around $370 well up to nearly $500. It's consistently paid its dividend. I think it will continue to do so. It will surely be a dividend aristocrat because of the reliability of its revenue. It has a safe payout ratio, and it's not going anywhere by any means. It's an essential company to the American economy and to the world economy. For these defensive reasons, it definitely has a place in some people's portfolio. 2.1% dividend yield and share repurchases are absolutely nothing to sniff at. It's not overly expensive at the PE of 20. However, for me, this is just too expensive for a company that in the next few years is expecting little to no revenue growth. I think it requires too much of a faith placed in management that I don't have the faith built up there. I don't think the management of Lockheed Martin is so good that I can believe them that in 3 to 5 years they will completely turn around this business. That is not in dire straits by any means, but it's not going to record any revenue growth over the next couple of years, and it's going to be declining if anything in 2023. So for me, this is a watch and wait type business. I'd be much happy to own this if revenue is increasing in the 3 to 5, 6% range, while also continuing to uphold its dividend share repurchases, which I do think it will get to. It's just not going to happen in 2023. For that reason, I don't think I'll be buying right now. But of course, let me know what you think in the comments below. Don't just listen to me because I'm not a financial advisor. You should do your own research and due diligence. Let me know what you think. Like and subscribe if you enjoyed the video. I'll see you again next time.